Peak earnings season is now wrapping up, but we still have some top companies reporting earnings this week. In fact, we have Nvidia, which is now the most valuable company in the world. This is very important to pay attention to, even if you don't own the stock, because it now has the ability to move the entire market. Nvidia is now 7% of the S&P 500, which is the most popular index fund most normal people invest in. So a big move up or down from Nvidia earnings could really impact the overall market. And to emphasize that even more, Nvidia is 8.74% of the QQQ, which is the NASDAQ 100, another one of the most popular indexes to track. So this really matters, but it also matters because of how Nvidia makes their money. All of their recent gains have come from data center revenue, and Nvidia's biggest customers are these other big tech companies, being Microsoft, Amazon, Meta, Tesla, Google, etc. So this one earnings report can tell us a lot about the overall market. Also this week, we have top dividend growth stocks like Walmart, Lowe's, Medtronic, Target, TJX, John Deere, and Intuit. All of these are stocks you may own or consider adding in your dividend growth stock portfolio. So today I'm going to go over earnings estimates for these companies and give a little brief stock analysis for each of them going into the week. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I'll be using my research tool available at dividenddata.com. I also want to share a great new use case that I will be showing throughout this video and using myself this week. You can summarize the latest quarters and earnings calls using direct transcripts and documents. This is done with my AI investment analyst tool, and this really saves you so much time. Rather than listening through an hour-long earnings call for all of your different companies, you can just get a quick summary of the most important details. And that can be important things like future guidance sourced directly from their earnings transcript. These earnings and quarterly summaries make it really manageable to actually follow all the news happening with all your stocks. And of course, that's just one example of the things you can do with dividenddata.com. And if you want to try it out, please sign up today as we have a 50% off sale where you can get 50% off for life of both the monthly and annual plan. This is the best deal we will ever do. Just click a link in the description and pinned comment of the video, or create an account on the web app, select your plan, and enter the promo code AI at checkout. That's the two letters AI. Now let's get to the earnings predictions. All right, so Tuesday before market open, we have Walmart, ticker symbol WMT. Walmart has beaten on both revenue and earnings per share in all of the recent quarters. And for Q3 2025, which is what's reporting on Tuesday, analysts are expecting revenue of $167.7 billion and earnings per share of 53 cents. Walmart is a $674 billion company, and by the numbers, it's the most successful retailer of all time. And so far in 2024, Walmart stock has performed really well in terms of price, and that has happened from a re-acceleration in earnings growth. However, I am personally concerned that the stock price growth is ahead of the business at this time. Walmart is a long-term dividend growth stock, and actually I believe is a dividend king, meaning it has over 50 consecutive years of annual dividend increases. And you can even start to see this re-acceleration in their latest dividend growth. The 10-year compound annual growth rate of the dividend was 2.63%. However, the latest Walmart dividend increase was 9.21%. But the question is whether that kind of growth will continue. For years, it looked like Walmart's earnings and free cash flow were basically flatlining, although they did continue to have top-line revenue growth in that time. So I'm actually quite surprised with how well Walmart stock has done lately. The increased valuation makes the current dividend yield 0.99%, and it is a sustainable dividend payment. The current payout ratio based on free cash flow is 40.61% and 39.58% based on net income. I think Walmart's a high quality business, but they're definitely trading at a very high valuation at the moment. And if we look at the trends of their different segments when it comes to revenue, Walmart US, Walmart International, and Sam's Club, those are all very high revenue businesses, but the margins are super low. So I personally find the most interesting part of Walmart's business being this growing membership and other income segment. That would be Sam's Club memberships and their new Walmart Plus service. And since the quarter ending in October 2020, the business has grown from $3.8 billion of trailing 12 months revenue to $5.9 billion as of last quarter. And this has much higher profit margins. So I would say this is the sneaky part of Walmart's business that would be in their bull case. And if we take a look back at Q2, you can see that they had revenue growth of 4.8% year over year, operating income growth of 8.5% year over year, and they saw e-commerce sales grow 21% year over year. And this is interesting. They have a growing advertising business, which grew 26% year over year. I want to look way more into this because advertising on Amazon.com is their number one most profitable part of their e-commerce business. So this might actually be a very interesting part for Walmart. And Walmart US saw comparable top-line sales growth of 4.2% year over year. But the most important part of this is they gave outlook for Q3. They're expecting net sales growth of 3.25% to 4.25% and operating income growth of 3 to 4.5% in constant currency. And that would be compared to Q3 2024. And last quarter, they raised their outlook for the full year 2025. That was sales growth of 3.75 to 4.75% and operating income growth of 6.5% to 8%. As I mentioned earlier, Walmart stock is now trading at a premium valuation, so they are going to need high growth to justify this moving forward. Next up, we have Lowe's, ticker symbol LOW, which is another popular dividend growth stock. They report earnings on Tuesday before the bell. Analysts are projecting revenue to come in at $19.94 billion and earnings per share to come in at $2.82. And it should be noted that they have beaten earnings per share estimates 16 of the last 17 quarters. While Lowe's stock price has performed well recently, they are actually in a pretty different situation compared to someone like Walmart. Walmart was seeing growth re-accelerating, while Lowe's has seen revenue, earnings, and free cash flow decline since they peaked in 2022. And the raw numbers are actually worse than the per share metrics I'm about to show because they buy back stock like crazy at Lowe's. They bought back 7.45% of their total shares outstanding last year, and in 2023, they bought back 9.73%. But even with that, they saw a 3.82% reduction in revenue per share last year. You can see a downtrend in net income per share in that time. Free cash flow per share has also consistently declined since 2021. And a lot of these share repurchases were funded with debt. And you can see their balance sheet has gone the wrong direction in that time. They now have $35.5 billion of net debt. But Lowe's has been a top dividend growth stock over the past few decades. Their 10-year compound annual growth rate of the dividend is 17.46%, but this is slowing down. Their past two increases were only 4.76% and 4.55%. And unless they can re-accelerate overall growth, then Lowe's dividend and their stock price overall may be in for a little bit of a rough patch. The current annual dividend is $4.60 per share, which is a 1.69% dividend yield. And while they're overspending on share repurchases, the dividend payout ratio has remained pretty sustainable. The current free cash flow payout ratio is 40.9%, and the EPS payout ratio is 32.76%. If we look at Lowe's business, they make 34.7% of their revenue from home decor, 32.7% from hard lines, and 30% from building products. So if you can't tell, they are in the home improvement industry. And that industry saw massive demand during 2020 and 2021 when everyone was at home and was flush with cash. So they spent a lot on improving their home. But since then, that demand has fallen off. But it doesn't mean that it will necessarily forever. On their latest Q2 2024 earnings call, and yes, this is 2024 for Lowe's, but it was 2025 for Walmart. And that's because many companies have different fiscal calendars. They're on different quarters for different times of the year. And some are nearly an entire year apart in how they start. So yes, this was Q2 2024. They saw sales down 5.1% year over year. And they noted softness in do-it-yourself demand and bigger ticket discretionary projects. They did see pro sales growing mid-single digits and online sales up 2.9% year over year. The company also gave an updated full year outlook for 2024 with comparable sales down 3.5 to 4%. They also are expecting an operating margin of 12.4 to 12.5%. So that actually is a reduction in their operating margin year over year, given that it was 13.38% last fiscal year. But it is still a trend of overall growth over the long term for margins. So overall, I wouldn't say it's a great time to buy Lowe's stock. Their current starting dividend yield is in the lower end of the past 10 years, at the same time that growth is slowing. And while they've had a great total return of 422% over the past 10 years, that also seems like it will slow. The 3-year total return is 15.42%, and that has really been floated almost entirely by the share repurchases, in my opinion. But if you've owned Lowe stock for a long time, then I wouldn't necessarily sell right now either. I do think it's still a long-term compounder. Since 1990, the total return for Lowe stock is 45,559%. And you may not be getting that in the future, but it's not outrageous to say that the 5-year total return could go back to that 160% range. That all depends on growth though. If Lowe's doesn't start growing again, they're going to be in a rough position. I don't own it in my portfolio and I wouldn't buy it at current prices. Other stocks reporting on Tuesday, I'm not going to do a full breakdown for these two, but you have Medtronic, ticker symbol MDT. Analysts are expecting $8.27 billion of revenue and $1.25 of earnings per share. This is a dividend growth stock that has been slowing down in recent years. The 3-year CAGR is down to 3.57%, and the most recent dividend increase was 1.45%. Starting dividend yield is 3.2% at current prices, but growth has flatlined at Medtronic. Also Tuesday before open, you have Jacobs, ticker symbol J. Analysts are projecting $3.01 billion of revenue and $1.37 of earnings per share. This has been a pretty good long-term dividend growth stock. The 5-year CAGR of the dividend is 11.27%. The current yield is 0.83%, and it's very sustainable with a payout ratio based on both free cash flow and earnings per share under 20%. On Wednesday before market open, we have Target, ticker symbol TGT. Analysts are projecting revenue of $25.9 billion and earnings per share of $2.30. This is another company that saw massive demand increases during 2020 through 2022. And the stock price boomed to new highs during that time, but then ultimately sold off a lot of those gains and presented actually a pretty interesting buying opportunity in fall 2023. And you maybe could argue it's still a buying opportunity today. Target is a long-term dividend growth stock. The 10-year CAGR of the dividend is 7.97%. The 3-year CAGR is 7.56%, but that's a little misleading if we dive into what really happened. The past 2 dividend increases have been 1.82% and 1.85%, but that CAGR number is held up from the 20% dividend increase in 2022. However, with stock price coming back down to reality, the current dividend yield is 2.86%. So that is a rather attractive starting yield if Target can re-accelerate dividend growth. The payment is sustainable with a 52.71% free cash flow payout ratio and 48% EPS payout ratio. And as you can see, Target went through some really bad earnings in 2023, and they're starting to recover towards growth now. Target reported a 2% increase year over year in comparable sales, and that was driven entirely by increased traffic in the stores. Earnings per share came in at $2.57, so they did beat guidance in the last quarter. They also noted that they have a loyalty program which now has over 100 million members, and they also gave Q3 guidance, and they're expecting 0 to 2% comparable sales growth in Q3 year over year, and earnings per share of $2.10 to $2.40 for the quarter. So if they beat that guidance, that would be ahead of analyst expectations, and I'd say it's likely that the stock price would go up over the following days and weeks. For the full year, earnings per share guidance has been raised to $9 to $9.70. The company also reiterated on their last earnings call that they remain focused on driving profitable growth, improving margins, and returning cash to shareholders through dividends and share repurchases. Also, Wednesday before market open, we have TJX Companies, ticker symbol TJX. And this is a stock I hadn't really analyzed before, and it's pretty interesting. Analysts are projecting revenue of $13.96 billion for the quarter and earnings per share of $1.09. This stock has done ridiculously well in recent history, and they've seen high and consistent earnings per share growth other than during 2020 where they lost a lot of money. And this is a dividend growth stock. They have a 15.67% 10-year compound annual growth rate of the dividend, and the most recent dividend increase was 12.71%. The current dividend yield is 1.25%, and it is sustainable with a 34% payout ratio based on free cash flow and 33% earnings per share payout ratio. The company also buys back shares consistently, but at a sustainable rate, unlike someone like Lowe's, for example. Free cash flow per share has grown at a 12.49% 10-year CAGR. I haven't analyzed the company much previously, so I don't have much personal opinion, but on their Q2 2025 earnings call, they said that they were optimistic about the second half of the fiscal year. They also have been improving their profit margins, and they saw comparable store sales increase 4% year over year. And they announced they're investing in global expansion with minority investments in off-price retailers in Mexico and Dubai. So based on the optimistic second half fiscal year, then I assume they're going to do well in this coming earnings report. Also Wednesday before market open, you have Williams-Sonoma, which is another dividend growth stock. I won't cover this one that in depth, but analysts are projecting revenue of $1.86 billion and earnings per share of $1.77. This is another company that has seen earnings flatline since 2022, but their stock price actually boomed in that time, and it has remained quite high. And finally, Wednesday after market close, we have Nvidia, ticker symbol NVDA. This is the big behemoth stock reporting earnings this week. Analysts are projecting revenue of $32.86 billion for the quarter, and earnings per share of $0.74. Oh, and just as a reminder, if you want to use the tool I'm showing throughout this analysis, it's available at dividenddata.com. Click the link in the description and pin comment. You can get 50% off for life. It's the best deal we will ever offer. Nvidia stock has just absolutely crushed it, and the stock price growth over the past 2 years has driven it to be the most valuable company in the world by market cap at $3.44 trillion. And no, it has not all been AI hype. There's actual real spend driving this increase in earnings at Nvidia. So before I get into their earnings and guidance, let's take a step back and understand what the key drivers are at Nvidia and why they had this massive increase in earnings. All of this is from data center revenue. That is now 87.46% of Nvidia's revenue. Over the trailing 12 months, that business alone has generated $81.75 billion. That's about 7.5 times the revenue of their gaming business, which just 3 years ago was the #1 revenue source for the company. All of this growth has been in the data center, and this data center spend is driven by the largest big tech companies. And this data center spend is all used to increase generative AI capacity. That's both for training new models and inference use of existing models. And according to their Q2 2025 earnings call, roughly 45% of Nvidia's data center revenue comes from the big cloud service providers: Amazon Web Services, Microsoft Azure, and Google Cloud. Here you can see the increase in Microsoft's capital expenditures. A significant chunk of that is going to Nvidia. And here you can see Amazon's capital expenditures by segment. That has grown from $2.2 billion in 2013 to $24 billion in fiscal 2023. And it is now the largest part of Amazon's capital expenditures. Google has also increased their CapEx over the past year. Consumer internet companies and enterprise companies are the other 50% of Nvidia's data center revenue. That includes companies like Meta, which spend $30 billion a year on capital expenditures, and they buy hundreds of thousands of Nvidia's latest chips. Other examples include Tesla, which is spending billions of dollars to build out massive data centers to train their self-driving AI. Another one of Elon Musk's companies, xAI, just built a massive data center and they raised billions of dollars, and it all uses Nvidia chips. So the big risk for Nvidia and their data center business is whether these big companies want to continue spending at this high rate. Short term though, it doesn't seem like that's going to stop. In Q2 2025, Nvidia reported data center revenue reaching a record of $26.3 billion, up 16% from the prior quarter and up 154% year over year. Overall earnings per share for the quarter was 67 cents, up 12% from the prior quarter and up 168% year over year. Gross margin was still very strong at 75.15%. And the company did give guidance for Q3 2025, expecting revenue of $32.5 billion plus or minus 2%. Wall Street analysts are projecting them to beat that number, so plus 2%. They were expecting a very slight reduction in gross margins to 74.4% to 75%. That's still crazy good margins though overall, and for the full year they're expecting it to stay in the mid 70% range. So the big question for Nvidia stock about whether it goes up or down will be less about what happens this quarter and more about the guidance they give for future quarters. And a large part of that will be driven by their upcoming new AI chips. That includes Blackwell, which is beginning to ramp up production in Q4 and continue into fiscal 2026. And I've already been reading reports that demand is incredibly high among big tech to get these new Nvidia chips. So that's the bull case, is that they continue reordering the newest versions so that they stay at the cutting edge. And it makes sense why all these big tech companies are investing so heavily, because the upside of the future growth that can come from AI over the next decade could be insanely massive. It's already very useful. I have my AI analyst in dividenddata.com. I can summarize these earnings calls and financial quarters, and it literally saves me hours of research. And we're still basically in the first inning of where this stuff is going to go over the coming decades. So if you're a company like Microsoft, Google, Amazon, you'd be stupid to not spend the money. And that's actually exactly what the Microsoft CEO said a few earnings calls ago. He said that the risk of not investing this much in AI is the real risk, not the risk of overspending. Because at any point you could cut it back if you spend too much, and these are highly profitable companies anyways. So the real risk is not being at the cutting edge, not driving the technology forward, and potentially being passed by the competition who do invest in it. So overall, I think Nvidia will continue just to rake in massive profits over the next year to 2 to maybe 3 years. But after that, it starts to get more uncertain, as I think that the growth of spend might slow down and the market overall will become more mature. But it is just a very hard to predict environment for what it will look like 5 to 10 years from now. And for Nvidia stock to do well from the current price, it's going to need a lot of future growth. Not just staying put at these high profitable levels, it has to keep growing from here. To wrap it up, I'm going to share 2 more dividend growth stocks that report on Thursday. That will be Deere, ticker symbol DE. That reports before market open, and analysts are projecting $9.38 billion of revenue and $3.94 of earnings per share. They have beat EPS estimates 16 of the last 17 quarters. Deere is another company that saw massive growth rates coming out of the pandemic. Deere is another company that saw massive growth coming out of the pandemic. However, they did see a decline over the past year in earnings, and the stock price has largely been flat since 2021. This is a long-term dividend growth stock with the 10-year CAGR at 9.37%. The 5-year CAGR is 14.1%, and they've actually started having multiple dividend increases a year during that period of high growth. For example, you can see they had an 8.89% increase, an 8% increase back-to-back, and a 4.17% and 6.19% back-to-back. The current dividend yield is 1.45%, and it is sustainable. The free cash flow payout ratio is 34.63%, and the EPS payout ratio is 14%. For Deere to do well, they need growth to re-accelerate. In Q3 2024, they said that they faced a tough quarter with softer demand in both agriculture and construction and forestry segments. Although they were able to maintain margins of around 18.5%, they have said that lower commodity prices and higher interest rates have pressured farmer profitability and equipment demand globally, and they expect to see double-digit declines in early order programs for planters and sprayers in North America. They also said they're expecting mid-single-digit underproduction for the full year due to increased competition and softening demand. That's for their construction and forestry segment. They did give full-year guidance for net income forecast remaining unchanged at approximately $7 billion. That's basically in line with their fiscal 2022 net income. So with this earnings call, you would be really focused on any positive news and growth potential. And finally, after market close on Thursday, we have Intuit, ticker symbol INTU. Analysts are projecting $3.14 billion of revenue and $2.35 of earnings per share. EPS has beaten estimates 14 of the last 17 quarters. This is a high-quality software dividend growth stock that owns TurboTax, MailChimp, QuickBooks, Credit Karma, etc. The company has seen fantastic earnings growth and stock price appreciation. And by the way, these big spikes in profitability are from TurboTax, since that is a very seasonal business. Revenue per share has grown at a 10-year CAGR of 13.91%. Free cash flow per share has grown at a 10-year CAGR of 14.25%. It is a dividend growth stock with a 10-year CAGR of 15.32%. And the most recent dividend increase was 15.56%. The current dividend yield is 0.61%, and it is sustainable based on both free cash flow and net income, 22% free cash flow payout ratio, and a 34.9% EPS payout ratio. Last quarter for them was Q4 2024, and they really have been seeing growth across the board. And on the product side, they've been focused on integrating AI throughout their platform. They're having AI-driven experts. In that quarter, they announced $3 billion of share repurchases and their latest dividend increase. And they gave guidance for Q1 saying that they expect revenue growth of 5 to 6% year over year for the quarter. They expect their online ecosystem to accelerate to 19% growth year over year. And they expect a 20% decline in their desktop ecosystem revenue. And this makes complete sense because they've been transitioning over the past few years to become a cloud software company. And this just means that you use their web applications. You can see the growth of their online ecosystem from $2.3 billion in October 2020 to $6.89 billion in the latest quarter. Their traditional desktop business in that time still grew a little bit actually, which is surprising, but that was mainly due to QuickBooks seeing growth in that time. I find Intuit to be a pretty interesting company company, so let me know in the comments if you want to see a full stock review on Intuit. So those are the main stocks I'll be paying attention to, which report earnings this week. Let me know in the comments, and I'm pretty sure that I'll do a follow-up on at least one or two of these companies as the news comes out. If you enjoyed the video, please leave a like and subscribe to the channel, and sign up for dividenddata.com if you want to use the research tool I showed throughout. Again, we currently have a 50% off sale, which is the best deal we'll ever have. Just click the link in the description and pin comment to get the sale directly, or create an account on the web app, select your plan, and enter the promo code AI at checkout. That's the 2 letters AI. Thanks for watching, and I'll see you in the next video.